Jerry.
Hi, Kim. How are you today?
I'm well, thanks. How about you?
Very good, thanks.
Good. So this is our part two of our series that we are doing on non-performing notes. And just wanted to, before we get started, uh, thank everyone for joining the Kim and Jerry podcast, and also be able to say that this is for education and information purposes only. We are not financial advisors or an attorney or CPA, but this is part of um, the information that we want to share with our community with non-performing note investing. This is our expertise that we do personally while we invest with other investors and use performing notes. We also have a very strong platform in the non-performing notes sector. And because we seem to be growing with a following, but people always ask, why would you invest in non-performing notes? And so we are taking the time right now to be able to share with everyone what we do and why we do what we do. Anyway, you want to take it from here, and I'll join in as you go along. But I know that you know your background and wealth of knowledge in this area is just something that we can all learn from. So take it away, Jerry.
All right, thanks. Um, well, today in this session, I'd like to really kind of walk you through the art of buying a non-performing loan. In
Mm,
the first session, we talked about the difference between a performing and a non-performing. And just to recap, a non-performing loan is one that is in default. Default is the borrower hasn't made a payment in over 90 days.
right,
So, um, and we, Kim and I, and some of our other partners for our personal portfolios will buy non performing notes. We buy non performers because we get a higher return than we do on a performing note, actually, substantially higher.
right,
But however, that return comes with more risk. And what we wanted to make sure we talk about in the course of these videos is how we mitigate and manage that risk so
right,
that um, there is a very low or a lower probability that we will lose our investment. Because with any investment, as all of us know, any investor knows, it's great to get a return, but the most important thing is you don't want to lose capital.
right,
So when we're buying these notes, our expectation is we're not going to lose our capital. And in the course of 8 years, we've we lost one. So
yeah,
and have lost very little capital as a result of that. So today I'm going to start out with what we call our buy box. The buy box is the criteria that we have for looking at a note and determining, is this a note that we want to purchase? So we start out before we do anything with laying out the parameters of what is included in the buy box and what is excluded. And while those parameters are pretty straightforward and well set, there is some flexibility.
right,
So it's not like it's all black and white. It's really a lot of gray.
right. But it's a
And
guide. It's a guide to
true,
go through the process.
true, true. And there are going to be trade-offs because the other thing that we all know, if you're a real estate investor, is that there are no two houses alike.
Hmm.
There are no two borrowers alike. There are no two neighborhoods alike. So while you may have a very specific criteria, you got to be flexible if you're trying to make sure that you're going to get a return on your investment.
Right,
So
right,
having stated all of that, I'll start with our buy box. For us, the first thing we look at is loan size. And I'm going to back up and say, we're looking for average.
yeah,
I have investor friends who buy on the very high end
right,
and others that buy on the very low end. And there are reasons for their investment strategies. They're buying on the high end because they're getting a better discount. And if there's a payoff, they get a much bigger payoff. On the low end, they're buying on the low end because they're spending much less capital on every note and they're seeing their money turn faster.
Right.
We're in the middle. And the reason we're in the middle is that our strategy is we're trying to work with a borrower to keep them in their homes.
Right.
And so you're trying to work with the average person to keep them in their home. So I'm
Right.
not looking for something too big. I'm not looking for something too small. Having said that, we look at our loan size. The loan size for us will start, I don't know, 5,000, 3,000, somewhere in that the mid um, four-figure numbers, and it'll go up to 50, $100,000. That's our range for the notes that we look at. Now
Right.
realize that we're not paying that much for the note. That is the price. That is the unpaid balance on the note.
Right.
Legal balance could be even higher than those numbers, but that gives us something to play with.
Right.
Some other factors that go into the size of the loan is that we do have holding costs, and you don't want your holding costs to eat up what your proceeds are going to be from a loan.
Right.
So, um, so that's first factor, loan size.
Yeah.
Second factor, house size. Again, when you're talking to investors in non-performing notes, everybody has their preference. For us, we look at houses that are, let's say, 50,000 up to maybe 300,000.
Mm-hmm.
Now, obviously, that can vary depending on geographic areas of the country. If you're in California, people would laugh at you. You're not going to find a $50,000 house. Um, if you're in Cleveland, and you say you're looking for $300,000, $400,000 houses, they're going to go, yeah, they're out there, but they're going to be more in that lower range. So again, we're trying to do something that's average for that for the areas that we invest in. You'll find that we don't do much investing in some of the more high cost areas. So house size, that's another factor that we use to help us stay within where we want to be.
Right.
The other thing that we look at, which is really, really, really important to us, is equity. We will not buy a house unless there is equity in that house. And again, my goal is not, I'm not trying to take anybody's house. I'm trying to work with the borrower to get them out of a bad situation and help them move forward in their lives.
Right.
So, my feeling is if you have equity in the house, which means you've probably been in it for a while, it means that you have put a bigger down payment on that house and you've paid down the mortgage over a period of time. You're not trying to lose the house. So when we excuse me. So when we get into a discussion and a negotiation with that borrower, they have something to lose as well. So we ought to be able to come up with some kind of an arrangement to help them and to help us. And ultimately, if we have investors involved in that, to help our investors as well.
Right. I think that
Next, okay.
oh, sorry. I was just going to say that there's a real strategy to investing in non-performing notes, and the strategy sort of builds itself out when you're doing the due diligence.
Mhm.
That
Yeah.
it begins to paint the picture of the note as well as of the borrower and the exit plan of
Mhm.
the note,
Yes.
doing the due diligence. And so as you're going through this, there's so many other things that I'm thinking about that, present itself in this process that become part of the consideration. That's a maybe part of the flexibility that you were speaking in reference to at the beginning when you were identifying the buy box.
Yes. Absolutely. Absolutely. Other thing we kind of look at in a great deal of detail is the location.
Mm-hmm.
The first cut of location is the state. There's some states that we really do not want to be invested in. Now,
Right.
if we buy a tape and those states are in there, then yeah, we'll take that note. However, I also, for the states that I'm not in, I also have um, affiliates, associates, other folks that are in the note business that focus on those states. And if I got a note in those states, they're going to be the first person I call.
Right. Right.
Hey, I got this in my portfolio. I don't want it. Will you give me a couple of points over what I paid, and it's yours?
Right. Right.
Of course, I shouldn't have said I'll give you. Yeah, I shouldn't have said that on a video, should I? Never mind. What will you give me for that note?
Well, what we do, what we can say is that the note is equivalent to money, right? And
Yeah,
so it's not too hard to get rid of money, right? To
that's true.
be able to and say to
It's
someone
actually
else,
very easy to get rid of money.
yeah. And so, there are different strokes for different folks in regards to this whole note investing industry. So,
Yeah,
um,
yeah,
and so we know those people. So we
yeah.
always present to them what we may have that fits more their buy box.
Absolutely, absolutely. The next thing that we look at is urban, suburban, rural. We tend to not get into very rural areas, particularly because we're doing non-performing notes. And our feeling is in a more rural area, it'll be more difficult to be able to move the product, to move the home if we wind up owning the home. And
Right,
and you're going to hear a common theme here. We're evaluating a non-performing note not to own the home because we don't want the home, but assuming worst case we have the home, what are we going to do with it?
right.
You know, I recall being on a webinar with one of my mentors once, and this guy had been in the note business, non-performing note business, for decades, and he'd never gotten a house back.
Mm.
And we're on this call, and he goes, "Yeah, yesterday I got a house. What do I do with it?" It's like, I don't really understand. What do I do with this house? And I'm sitting back going, well, because I'm a landlord. It's like, well, I know what you do with the house, but he was confused.
Right,
You like, dude, you got a $600,000 property there. You better figure it out.
right. The exit strategies are endless
Yeah, yeah,
with, but you have to know what the options are.
true, true. So for us, like I said, urban, suburban, that tends to be in our buy box. Rural, not so much. However, like I said at the beginning, everything's gray.
Right,
So you're going to see when we do case studies, there are going to be some towns you're going, what? You bought, I thought you didn't do rural. If the note's good enough, I'll buy it. so, um, so buy box, rural, urban. And I said, when we're looking at location, we do a very deep dive. One of the things we do is we dive down into the zip code.
yeah,
Kim, we go to, what is it, bestplaces.net,
yeah. You can
and
get a
we
wealth
put
of
in,
information there.
yeah. When we're going through, we put the zip code for the property that we're in that application, or in that on that website, and we get back information, which helps us to be able to get a feel for what's that area like.
Right,
So we'll look at, median household income. We'll look at what the vacancy rates are, because vacancy rates help us to understand how long would it take to sell this house if we have it. If you're buying a property, and I remember we're looking at a place out in Lake Havasu, I think it's California, Arizona, somewhere out west. You West folks coast, you know where that you know where that is. But we're looking at Lake Havasu, and it got a 50% vacancy rate. And we're going, there's no way. I don't want to live in Lake Havasu.
right, right,
We're going to have this house forever.
right.
So vacancy rate's important. We want it because your holding costs of owning a piece of real estate can start to go up and eat away your profit. So vacancy rate's important.
Yeah,
Rental rates. Is this a rental community? And if it's a rental community, maybe I can rent the place if I wind up having it. So
Right.
that's as Kim said, that's an exit strategy. We look at a median household values in the zip code. And the reason I keep saying zip code is that all of us know in every city in the United States, there are some places with high property values, low property values. Just by saying New York doesn't tell you anything. Saying Detroit doesn't tell you anything. Telling you XYZ zip code tells you a lot because it starts to help you understand, is this a desirable area?
Right.
Is this a place if I wind up with the house, where, who's going to buy it from me?
Right. Right.
And, like I said, it's gray because I have some strategies for if I get in a place that I didn't think I was going to have to own this house, I do have some strategies for how I'll get out of it.
Right. And so some of the things that come out, the crime rate in a particular location,
Yep,
that's key, because it does factor into your exit strategy. Um,
absolutely.
the school systems is another
Spot
big
on.
factor. So when you're talking about drilling down to the zip code,
Mhm.
these are the characteristics that are identified by the zip code that gives you the leverage to understand your exit strategy power, if you
Yeah.
will. So,
Yeah. And,
um,
Kim, you were saying school systems. There's a note that I know we're looking at right now, and the property is in one of the best school districts in the state.
yeah, I think so. I saw that too. I was like, I haven't seen those ratings.
Every school's rated 9 out of 10.
Every school, every
Every
school.
school doesn't matter what, it's like this is a location where the public schools are private schools or something like that. I don't know.
Everyone can read there, that's for certain.
Yeah. So I know that if we wound up owning that house, it's a piece of cake to sell
Yes,
it
right.
because folks want to be there, as
And that's
opposed
what I
to
mean by
flip side. Yeah, yeah,
your power, right? Your exit strategy power. I
exit
mean, it
strategy,
automatically positions us to know that this is, like you said, it's going to be a piece of cake.
piece of cake. Yeah. Um, Next factor is we look at the borrower and the borrower credit history.
Hmm.
Um, Typically, when we get tapes, we get the credit reports. If we don't get the credit reports, we'll run the credit reports
Right.
and pull that information down to get an idea of who's the borrower.
Okay.
And as we're looking at it, I've said this before. We're looking to make sure that we're dealing with borrowers that appear to be um, interested in doing meeting the contracts that they have signed. There are going to be some borrowers that you will look at and you'll go, "Hey, this is a serial bankruptcy person." And what does that mean? That means that they figured out that the way to get out of debt is to file for bankruptcy every 4 or 5 years. I don't want to deal with those guys. It's just life is too short. There are other folks that play other games with bankruptcy and foreclosure. So I've seen people that this house has been on foreclosure 6 times. It's like they just don't want to pay. And then when they are forced to, they'll pay to get out of foreclosure. I don't want to deal with that. So we're looking for factors like that. You're also looking for factors that may have caused people to get into this situation. So, hey, you had a medical condition. I can see all of the medical bills. So I want to be the person that helps. So I buy the note and can I help you stay in the house? So my thinking is when I'm looking at this, well, I could modify this, lower their payments, stretch out the term, and have a good day. So borrower history, credit history, that's another factor. And we're looking for certain types of borrowers to be able to make sure that we're going to be able to get our money back. Final thing is we look at lien position. Is it a first? Is it a second? Is it a third? That's
Right.
important.
Yes.
Um, and what I'll say, and we'll talk not in this presentation, but in other presentations, we talk about yes, you can foreclose on a house with a second lien, just like you can with the first lien. It doesn't matter. The
Which
law is
normally
law.
gets the borrower's attention.
It does very quickly. I can guarantee it. The other thing that I'll say about lien position is that it is not uncommon for us to find a loan that is being sold to us as a second that is actually a first.
Right.
And,
So the
because
discount is even deeper than what we initiated, right? So
well, yeah, Kim, those are the times when I do the happy dance, Kim,
yeah, yeah.
because
I always know. I always know.
yeah, yeah, because the seller, the financial institution that owns it, the hedge fund, the money center bank, whatever, they don't know that the first was paid off.
Paid off, right? So
And they're selling it to me like it's a second, a
right,
non-performing second. And I'm not going to tell
right.
them. Yeah.
But it also gives you that power that I was talking about in regards to leveraging your exit strategy, right?
Yes.
Because
Yes.
now you are the first,
Yes.
acting as a first lien
Yeah.
against the house that you got deep discount on, and
Yes.
there's several hundred thousands of dollars that's in equity of this house based on a second,
Yes.
so um, you just really became very much empowered to be able to resolve and what's the right word for that? But the note gets satisfied.
Absolutely. Absolutely. And that kind of leads to the final criteria that we have, which is looking at the numbers
Hmm.
and looking at the returns that you're going to
Hmm.
get on a particular property. We'll talk about that in the next video. But with a first or with a second that is actually in first position, our combined loan to value gets to be very low.
Right,
So you may be buying a note on a house with a 5% or 10% loan to value.
right.
When I say that my criteria it's gray and it moves, yeah, if you're out in a rural area, you're in a cornfield and you have a 10% loan to value, I'm probably going to buy the note. you
Right,
know,
right, right,
because it's very hard to lose when you buy a $10,000 note on a $300,000 house.
yeah.
So, um, the
And
final
and
factor,
every house has its value, right?
every house
Somebody
has a
loves
value.
that house.
Yeah. And if you bought it for 10,000, I'm sure you're going to find somebody that has value, particularly the owners of the house.
Right, right,
They're
right.
not going to lose a house. They're not going to lose a $300,000 house for a $20,000 note. They'll find the money. So
Yeah,
anyway, that's our buy box. That's the criteria we use to help us to mitigate and manage the risk of owning a note or buying a note. The
right.
next aspect of you're gonna a fill in there, Kim.
Yo, go ahead.
Okay. The
No,
next
I was waiting for what you were going to say next about your next aspect.
yeah.
But
Oh, yep. Next aspect is legal.
yes,
And for us, because we buy non-performing notes, one of the pieces of diligence that's really important that has a greater impact on a non-performer than a performer is understanding the legal aspects. So one of the things we looked at, and I kind of mentioned it a little bit when we talked about the borrower, is bankruptcy. Are they in
hmm,
bankruptcy? If they're in bankruptcy, that changes your strategy. Doesn't necessarily mean that you don't want to buy the note. Actually, you may want to buy the note if it's in bankruptcy.
yeah,
But you want to know that because it helps you determine what is your next step and how do you move forward. The
yeah,
other thing is this a one-time event or is it a historical? They're always doing bankruptcy. So we're looking at bankruptcy as another issue to make sure we understand that situation. And like I said, we buy bankruptcy, we buy loans that are non-performing in bankruptcy all the time. Love them. They're great.
yeah. There's a strategy, and we've become experts in it, and we know what to look for.
Mhm.
But
And you're going to
you
get
know,
paid.
you ultimately you're going to, because there's a trustee assigned to the bankruptcy, right? And so you become part of the plan that must be fulfilled in
Must be paid
regards
off.
to payments. Yeah, so you're
Yeah.
going to get paid.
Yes. Next thing you look at is taxes. You want to make sure that property taxes are paid, or if not, that you have a plan. So
Right,
again, I go back to that rural house. I bought the note for 20,000. It's a $300,000 house, but they have $5,000 of taxes in arrears. Well, I know
right,
when I buy the note, I'm gonna have to catch up on those taxes.
right, right,
Now, remember also, you can bill it back. You will bill it back to the borrower. So it's basically you're loaning them money. But you want to make sure the taxes are taken care of because you don't want to lose the property in a tax sale. Or you
right,
don't want the borrower to lose the property because the taxes take or property taxes take a precedent and have a higher lien position than even your first mortgage.
right. And then the other thing that it also be checked is the insurance on the property, because if things are in default, right, the insurance is also something to make sure that is also current. And if not, we
Yes,
need to look at putting insurance on the property if you're going to invest in that note.
absolutely. Next legal factor, you look at foreclosure, then the foreclosure history. You know, has the loan been modified before? Has it been through foreclosure? So those are factors that you're going to be looking for. Is it in foreclosure now? If it's particularly if it's a second, where's the first? Is the first current? Is the first delinquent? Is the first behind? And how does that factor into what should we do with this note? A couple of things that most people are not familiar with in the real estate space: super lien states.
Mm,
Uh, it's a
right,
term that most people don't know anything about.
right.
So typically, when you look at a mortgage in most states in the United States, property taxes have to be paid. Then next is first lien, second lien, and everything else. In some states, HOA fees take priority over the first lien. So you
That's
want to
right.
know, are the HOA fees paid and is it a super lien state?
Yeah, and that
Because
gets
you don't want to
overlooked
get
sometimes.
yeah, yeah, you don't want to if you go out and you're doing your lien search and you see that they're HOA fees, you want to check to see if it's a super lien state.
Right,
Because I don't want to have a $500 HOA person jump in and take my $300,000 house.
right,
you know,
right.
so that's important to you.
Yeah,
Final thing about the legal is statute of limitations. Again, that's something that most of us don't think about, but with that, there is a statute of limitations for some portions of the
um,
debt that
right,
someone may owe. So you want
right,
to make sure you understand that and also talk to your legal representative about those kinds of issues if you think that could be a problem for you.
right. And that should be done early in the stage of due diligence in regards to you should understand whether or not there's a statute of limitation and where does this note fall in that timeline. Because, we had a situation not too long ago where the statute of limitation was based on the very last payment made, right? And then the clock started. Um, and so you really have to take a close look at what the rules or the laws are for that state for that note.
And it's the first time I ever dealt with statute of limitations. I called a lawyer.
Yeah,
Yeah, and
it was easier.
what I'll tell you, for those folks that are looking at investing in notes and you're doing it on your own, whatever, you want to make sure you're talking to a lawyer that is an expert in foreclosures and bankruptcies and those kinds of things, representing the borrower, or excuse me, representing the lender, because they will have more knowledge and more experience.
Right, right, right,
Um, and they can give you some more guidance, particularly about around the subtleties of things like super liens and the subtleties around the statute of limitations, because there are a whole list of criteria that have to be followed on that for that issue to be resolved or to be factored in.
and no two states, no two notes are the
No,
same. Yeah,
absolutely,
in the
absolutely,
agreement, right? the agreement that
Absolutely.
was made.
Yeah.
So
So finally, just kind of my takeaways here. One of the big differences between what we do with our performing analysis and what we do with our non-performing is for a for all of our notes we expect the best. We expect to be paid. We expect that the borrowers are going to stay in the house. Life is going to be wonderful. With a non-performing note, we expect the best, but we are over prepared for the worst
that's right. Right.
because I am not trying to lose money.
Right. Right.
So
And
I want
and this
to.
comes down to managing your note. I'm sorry for interrupting, but I think that's something else that we also should press upon people's mind is that you really need to manage your notes. Not depend on the service provider and or the day-to-day expectation. It is something to manage on every 10 days, the note, and understand, where it is, what the status is. And
Kim, you're
uh,
trying to set us up for part four.
I'm sorry. I knew about part three, but yeah, now as we speak, it continues to grow. I think there's just so much more we can still talk about in the non-performing note.
Yeah, yeah.
So, okay. I'm sorry for interrupting. Did I mess you up?
No,
Do
no,
you
no.
know?
That's Yeah, that was good. That was really good. Yeah, but yeah, it's the management of the note it's critical
It's
because
critical.
that's going to determine whether or not you're going to get how quickly you're going to get your money and what kind of return you're going to get.
Right,
And
right,
we'll talk a
right.
little bit about that in part three.
Okay. Okay.
All right.
Yeah,
So,
I'm looking forward to part three because I think we have some um, slides that we can share to show the different type of notes that we've invested in
yeah.
um, as a non-performer, and how they unfolded, and what the yield was, and the return on the investment.
Mhm.
It's pretty exciting, and I can't say it's the norm because with non-performing notes there is no norm, but except that you can expect a greater return from a non-performer if you work it than you would from a performing note. We've had some
Absolutely.
really great successes, with non-performing. It's exciting, exhilarating. I love the strategy. I love the game. It's like playing chess. And all three exit strategies is a success factor as far as I'm concerned with a non-performing note. Whether it gets reworked and modified and they start paying, or if it gets paid off early, or we move through the process of, because it went into default, that we have to go through foreclosure. So nevertheless, it's exciting. So we
Absolutely.
have a lot more that we talk about and go through with due diligence with non-performing notes, and it's very much a part of our community. We have a community called the Shield, Connect with the Shield, and at this community, we actually, do due diligence together. We actually will help each other out, roll our sleeves up, and look at all the non-performing notes and what makes sense to invest in, and um, everyone learns from it because, as we said, no two notes are the same, and it's pretty exciting. So if you would like to join us, please, you just have to connect with us. And if this was something that you enjoyed, this particular podcast, please, subscribe and hit the like button for us, and um, stay tuned for part three because I think that's even going to be the best one of all that we'll speak about for non-performing notes. And please visit our website, www.firstshieldfinancial.com. And we have other YouTubes that also address this matter, that you could take a look at on our channel. I don't have anything more, Jerry. Do you?
I think that's it, Kim. Remember three possible outcomes,
Three
and
possible
we're
outcomes.
kind of walking through them.
Yep.
So, um, thank you for giving me a chance to talk about this, and look forward to talking to you in the next podcast.
Yep. Thank you so much. Appreciate you.
All right. Bye bye.
Bye bye.